Hi there, traders. Now, I've had another great question from Liwi regarding staggering trades, right? Otherwise known as averaging in, averaging out. There's all these sort of different terminology for it. But what you're trying to do is diversify your risk management according to the situation. Now, let me just run you through some charts here and I'll give you a bit more detail. Now, when we are sort of looking at an opportunity, this really happens on a really high impacting, highly anticipated macroeconomic event where the market's so geared up towards it. If it gets the right number, it starts to run, it changes the trend of the currency. So this is very relevant, obviously, if a central bank, especially the Fed, has a bit of a change of policy, then we start to see some big moves. And when it starts to run, right, this is why are we talking about staggering trades? Well, let me just put all the arrows up here. You can see very clearly what's going on. When it gets away from the actual trend lines themselves, like this entry level here is the best entry level, right? It's right at the event. Now, it may have already gone through when the announcement is made. At that point, you lose control of the entry. That low risk, high probability entry, it's gorgeous. But when it's gone, you're sitting back and you're sort of scratching your head. So what can we do here, or what should you do? Now, a situation where, let me just blow up this euro chart, make it bigger. So the situation is when a currency moves like this, right, and especially the US dollar and especially the Fed, this will be the medium-term trend, not just overnight. It's going to be like this for the next, weeks. So we're expecting a move, say, from 120, 120, at least 300 or 400 points, right? But once it moves, here's the initial entry level. Once it moves down here, you're into no man's land. So what you have to try and do is you still got your risk management and you want to apportion it like in the same ratio that you would with this trade at the top, okay? Now, once again, this really comes down to your own personal risk appetite and cash or capital at risk. So you have to work out what your sort of general, say your monthly budget is. Say it's 5 or 10, or say it's 10 grand, right? You can apportion that 10 grand. If you're trying to make 10 grand, you shouldn't probably be trying to risk more than 3.5, 4 grand to make that 10, right? So then you can backtrack and work out your trade size. Now, we know when this trade is entered, right? Ideally, having a stop loss above this trend line is the right level. But when it moves, say from this level here, say 120, 120, down to like close to 120, the figure, like 100, 120 points, right down here, you can't realistically put a big trade on here with a stop loss above the trend line, right? Your risk reward ratio there is disproportionate. One bad trade here, it comes back for whatever reason, your account is blown up and you're out of cash. It doesn't work, right? So you got to sort of start to think about this. Now, when it comes down to staggering in, okay, so let me just explain staggering in. What we're trying to do is say you've got a trade size of 10 lots, right? And that's your normal trade size. So if you saw a trade up here, you put 10 lots on, you got a great entry, you know exactly where your stop loss is, and away you go. Now down here, let me just change the color of the pen. Down here, that's not going to work because the stop loss is too massive. So what you would be doing is trying to break up that 10 lot trade and stagger the trade in. So you can't afford to have 10 lots going from say 120.20 to 121.20, right? 100 points. You're looking at what, 10 grand. You don't want to be losing 10 grand to make 10 grand. So what you would do is you would break your trade up and stagger the entry levels. You may have a quarter of the trade size, say 20 points above the market, another 20 points, you have another quarter, right? Now these, and another quarter as it goes up. So you're averaging out, staggering your entries. So if it did hit your stop loss, you would have the same risk ratio as a normal trade that you're putting on, right? So the first question here was, when do you want to use staggered trades as opposed to the regular trend line entry? Well, it's when the currency shoots, right? And we are starting to talk about going from a short-term to a medium-term trend, like a longer-term move. This is where, when you don't have any trend lines close, you've got to start using or look to stagger your trades in, okay? Break up your capital into components, not huge risk on every aspect, but as a group, they have the same risk profile as your normal capital management, right? So when would you start to stagger the trades? When there are no trend lines and you've got extremely clear direction, right? That's the answer to question one. Now, question two, does each individual trade share the same stop loss, price level, or pips? Well, this comes down to your own personal preference. To me, right, I would choose a stop loss level. Now, with a trend line, if I was getting short here below the trend line, okay, it's pretty easy to me to go, yep, well, I want my stop loss above the trend line. It will protect me if the currency bounces and I get a better chance to stay in the trade, right? So that's where you are. Now, that has one stop loss. Now, you can break that trade up there into 4 components or as many as you like, and that will allow you to, if the currency starts to go down, take some cash off the table as it goes. Now, when you're staggering trades, the question was, do each of the positions have the same stop loss? I would say yes. It doesn't need to be, but you have a stop loss level. Now, when you are looking at, there's another thing here about how far should you come back looking for retracements? Well, in an ideal world, the currency breaks down and it comes back to the trend line and then goes. We know, if you've been through the FX Pro Trader course, if the data is significant, especially say from a central bank and it's trend changing, well, you're going to get the move and the retracement, because of the significance of the news, will be muted, right? It'll be limited. Like in this situation, it's bounced like 30 points. Okay. So from that very first top after the initial retracement, that's probably the key level to be focusing on, not the trend line, right? So from this point on, if the currency is sitting around 120, the figure, okay, down here, you could be thinking, quantify your risk management. You want to have your stop loss at least above 120.40, right up here. So then you go into your entries, and I'll make these blue. You may have your entries every 10 points, and the trade is broken up into components. Okay, so each trade was a quarter. I would generally, because I know exactly where I want to get out, and I make sure the position size works out. So if it hits my stop loss, I lose the same amount as my normal trade structure, right? So you can actually, in actual fact, this just depends on your own personal risk appetite. You may stagger your entries here, right? So this is trade 1, trade 2, etc. And you may have stop loss 1, okay, stop loss 2 at different levels, right? It's really up to yourself. But to me, if it goes to a certain level, I want to be out of the whole position. That's why I would generally have 1 stop loss, but I could have 4 different entry levels as the currency slowly rallied. What I'm trying to do is, I'm not trying to pick the top. I want to be in the trade because I know it's going to go, but I don't want to put all my eggs in the one basket, because if it does rally, I want to give myself a chance to get in or average in at a better level. I know exactly where my stop loss is, above the market. And what that does is it allows you to comfortably get in with little risk. You're still going to make money, but if it bounces, right, you get into the trade with your same trade size at a great level, and you're ready for the move down. Second part of that question too is, say I have 2 individual trades, say long dollar yen at 110.30 and 110.20. Do they share the same stop loss price level, say 110, or does each of them have the same stop loss, say 25 pips? No, okay, this I've sort of answered that, but say for instance, you have, okay, 2 or 3 different, or say 4 different entry levels, right? They would not all have the same stop loss, because if I know if it goes through a certain level, say I'll pick the level here, my stop loss is up here, right? They would not have the same stop loss. Like this last one may have a 15-point stop loss. The second one here, maybe if it's 10 points below, it's 25. This one here's got a 35-point stop loss. And this one here, if I'm using a 10-point stagger, it's got a 45-point stop loss. Those stop losses added up with the trade size should equal your normal trade risk management, right? So they don't need to have the same number of pips. What you would do is proportion your entries so your risk management has the same structure. You don't want to have these one trades where, you're making $2,000, and then all of a sudden you lose $5,000, right? It's got to have the same structure. So in that situation, you would stagger your trades. Say, for instance, okay, as I just said, you've got a 45-point stop loss on this one, 35, 25, 15, and then you work out, say it's a 60-point stop loss overall. Then you can come back, say, well, I'm risking $2,000. I've got a 60-point stop loss. What's my trade size? Then you'll work out your trade size and just put it in, whether it's 2 lots, 2 lots, 2 lots. Okay, that's how you work this out. But why are we trying to do this? Once again, because there's no trend lines down here. And if you don't start staggering in your entries, right, you're not going to get into the trade and you're going to miss the whole move, right? Question 3, what's the rationale advantage of using a staggered trade compared to the regular one you enter? All right, we've sort of probably already answered this, but say, for instance, you have the initial trade here, right? You've got the entry level, the currency breaks down, it moves, okay? You get, moves down 100 points, you take your cash off the table, there's dollars in the tin. That's great. That's great for now. But, okay, so you square and it's here. Where's your entry? If you don't stagger this, right, your entry is near the trend lines. That's where the trend lines are your friend here, right? That's why we utilize trend lines, because we know the market will have a lot of activity there. If there's no trend lines, but you have exceptional direction, especially from a central bank and especially from the Fed, you have to use this profile. Otherwise, you're sitting around going, well, I've got to wait for a trend line, but there are none, right? And if you looked at all the currencies, when they move like this, right, there are no trend lines across the board. So the situation is you've got to use this stagger method to get in, or the other thing would be go to your daily charts and look for trend lines there, okay? But first and foremost, you're looking to get into the trade before it breaks the daily trend lines. And if there are opportunities here, well, then you need to take advantage by using this staggered method, right? Otherwise, what are you going to do? You're going to sit there with your a situation where, okay, you've entered, you take profit down here, you're happy days, you're locked in some cash, you put your entry level back up here, right, in a normal trend line, normal market profile, but it never gets there, right? So you miss the opportunity. So that's why we start staggering in the entry to get you into the trade. It won't usually be the whole trade size. You might only get one trade entered, okay? You may have 4 staggered entries here and only 1 gets entered. Well, that's good enough because you're still getting the next move and you're still adding cash to your account. Don't forget, trading isn't all about making all of your money on one trade. This is just one trade that goes into your pot to build capital. So don't get over greedy and overzealous with the opportunity. How is this different from adding to the loser, which I thought is something traders never do? Well, it's completely different, right? Say, for instance, I was long here and long and long. Yeah, that's just adding, like buying. You're just building a bigger hole. It's completely different structure to staggering in. This is like just, if you're buying all the way down here, you're just digging a hole. But in actual fact, if you had a clear plan here and the stop loss was down here, well, it has got the same profile. But what we're talking about as traders with knowledge and understanding is understanding direction, right? I wouldn't add to a bad position here. And generally adding to a bad position, which you're adding to the loser, is usually done without a plan. The plan isn't the initial plan wasn't to be out of cash. So you just start adding to the position with no sort of structured plan. Now, when you are going with staggered entries, it is a part of the plan. You've got direction on your side. What we don't know is how far it can bounce, and you structure the trade with good risk management. So you're not going to lose your shirt on the one trade. If you just went long here and the currency's now down here and you're like, well, I better average in to try and make some cash back, right? That's random. And then it goes low and you're like, well, I better buy some more down here because it's going lower still, right? There's no structure to that trade. What are you buying for? The move is down. You don't go trade against the trend, right? That's just idiotic and suicidal. You got probably about a 1 or 5% chance of getting out of that alive. And after an event like the Fed, right, with clear direction, if you're buying, you are just emptying your account. So staggering trades, staggering your entries otherwise known as averaging in, is the way that you can get in when there are no trend lines. The entries, they do not need to have the same stop loss. Although to me, my plan is I know where the threshold is and where I need to get out. So I would have them all at the same entry. Would I have them all grouped up together? You don't need to be. They can all be separate individual trades that you can manage individually. That's ideal. That way, if the currency does start to move in your favor, right? It's down. Well, that's not a good color. Let me just change the color of that pen. So the currency did move down this way. Well, then, you know what? Trade one. I can take profit here, and then I've still got 3 trades in play. If I manage to get in on all of them, if it keeps going down here, I've got trade 2. I can take some cash off the table there. So the good idea is break the trade up. It allows you to manage the risk, take some cash off the table, and keep you in the trade. The idea of staggering into the trade in the first place is to get you in when there are no trend lines, okay, with the same risk profile, and allow you to take advantage of the overall opportunity, right? I hope that answers your question. If it doesn't, by all means, drop us a line and I'll try and explain a little bit further. But understand, this is not something you do all the time. It's only when there's big events and where the currencies disappear from the trend lines and you're sitting back going, well, where do I get in now? Well, think about it. Think of your plan. You can get in with a small trade with the biggest stop loss, same risk profile as your normal trade. It just gets you into the trade and allows you to take advantage of the next 150, 200 points. All right. All right, guys. All the best. Cheerio.